Hello and welcome to this week's session where we have with us today Robert Jackson from BTMR in Manchester. They are an accountancy firm, a tax specialist. So we're going to talk about the dreaded tax today, payable on property, both from an acquisition perspective as well as a long-term landlord perspective. So thanks for joining us, Robert.
You're welcome, thank you.
I'd like to start with, and rather than make it too specific, because we have to appreciate that everyone's tax situation is different. But what I'd like to do is give you a couple of scenarios.
Sure.
So let's start with, we've got let's say a typical investor, they're buying a property for £200,000, it's their first property. How would you suggest the most efficient way, number one question, to buy that property? Would it be an individual name, would it be a company? And then secondly, just talk a bit about the taxation points, both from an acquisition as well as what that person would suffer, using your words, from a taxation perspective, whilst they own that property.
Okay. I think what I would be doing is first of all asking the prospective purchaser what his intentions are. Is he just going to be buying a single property, okay, or is he going to be building a portfolio of properties? Because the advice that will be given might well be different. I think the second thing I would ask them is, are they looking for an investment that's generating income? Is their objective to generate regular monthly income? Or is their objective more to build the portfolio for capital growth purposes? Okay. So long-term or short-term? Once you've established those parameters, then you would start to get into structures and everything else.
Okay. So just to stop you then, so if
Sure.
I answer the two questions then, so I want to buy a single property. I don't think I'll be buying any more properties.
Okay.
And I want to take income from it.
Okay. Then I think, generally speaking, there are always exceptions, but generally speaking, I would suggest that they buy that individually, or if they're buying it with their partner or whatever, buy it in partnership.
Okay, but just in their individual name?
In their individual name.
Okay.
That reduces the compliance costs. Limited company, for example, will cost administratively more to run.
Okay.
And when you've only got one property, the tax costs of owning that property are more beneficial. You pay less, in effect, owning it personally. Okay. It does depend on your tax rates, but generally speaking, that's...
And taking into account that there's going to be some cost for someone like yourself to manage that and manage the company, or account for the company. Yeah,
exactly. All he or she has got to do, if they own it personally, is add that income to their tax return. Okay. Whereas if you were going down a limited company route, you'd be talking about a set of statutory accounts, filing with Companies House, etc., etc., etc. The compliance costs don't justify the income generated from one property.
Okay. So as a question in between, i.e. the next question will be, if you're going to set up the same type, or what would the structure be for a larger portfolio? But as a sort of sub-question, if you've got a property in your own name and then subsequently you do decide, you have a good experience on the first acquisition, you've got your rent coming in, you're enjoying the income, and then you think, I'd like to buy another property. So then you start getting into the portfolio building, and you might decide, that you want to build a portfolio. Migrating that property over into a company at a later stage?
Generally speaking, probably not, because there can still be, depending on whether you're a non-UK resident or UK resident. If you're non-UK resident, then you are entitled to a tax-free allowance, which is currently around £12,500, before you pay any tax on that property income. Okay.
So just to hold that there then. So I could take rent of £12,500 without paying any income tax on that?
Correct.
Okay.
That's after all your deductions and everything else.
Okay, so it could be more than that, as long as
your gross rent could be a lot more than that. Yeah. But you've then got all your costs allowable against that. It's the net rental income of £12,500. Yeah. Okay. So even if you're starting to build a portfolio, there might be an argument, subject to your own personal circumstances, to still retain ownership of one or two, maybe sometimes personally, and then build the rest of your portfolio inside a corporate structure or a different legal entity. Okay. the other reason for saying that is that if you are sitting on a property that is pregnant with gain, i.e. there's an inherent profit in that property, then even though it's your company or your separate entity that you want to move it to, you'll pay capital gains tax transferring the ownership from yourself to a limited company. Okay. If it's not, if you've not made any capital growth on it, then there may be an argument to push it into a limited company, but you're still going to be paying legal fees, you're still going to be paying stamp duty on the sale and purchase, subsequent purchase.
Sure. So client buys it, maybe sort of 2 to 3 years on, there may not be huge gains. Think about moving it into a company, but the downside being they've paid stamp duty once to buy it in their own name, then they pay it a second time to move it into the company. Yeah. Okay. And there's no relief around that from a sort of, no, okay. Okay. So let's think about the landlord then that wants to build a portfolio. He's either maybe got a couple of properties. So we deal with a lot of clients maybe where we're building a portfolio from zero. In a lot of cases, landlords that have already got maybe 2 or 3, 4 properties and then want to start buying more properties, happens to be a prosperity property. So then we may then again work with that client on a single purchase or multiple purchases. But ultimately, let's look at someone now that's looking to build a portfolio. So what would your advice be about how that person structures structures the purchase? And then also, is there a tipping point from the point of view of 2 properties, 3 properties becomes a portfolio for a professional landlord, i.e. the type of structure you're going to suggest?
I suppose there is a tipping point, and that tipping point is all centred around that allowance that I was referring to earlier of your net rental income. So if you've got £12,000 or £12,500 worth of net rental income, depending on what income is generated from your small portfolio, that would be one particular point where you say, well, I've maxed out on that, so I now need to move into a different structure. But remember that 12,500 only applies to non-UK residents. Okay. If you're a UK resident, then it's just added to whatever other income that you've got.
But you don't get the allowance.
Well, you get a personal allowance.
Okay, you get it once then.
Yeah.
Okay.
So what the government have done is, in effect, given the equivalent of a personal allowance to the non-UK resident.
Okay. Okay. So that goes in some way then to compensate for what the non-UK resident would pay in stamp duty. So just before we move on to stamp duty then, so the structure then for our multiple property owner, professional landlord, he wants to build a portfolio, what would be your advice there? What type of structure would be put in place?
I think that has to be a corporate structure, and setting up a UK company is not prohibitively expensive these days. It can be done from as little as sort of £70-80 up to a couple of £100. You can choose the name that you want, as long as it has a UK registered office address and it's registered with the UK tax authorities. It can be owned by overseas nationals, not a problem, or UK nationals. And that's the way I think to build a sort of a portfolio of in excess of 2-3 properties. That's the route to do it through.
Okay. So if you're generally thinking your appetite for buying property could increase and you maybe got 1 or 2 properties, but then from there on you still perceive that you want to build a portfolio, or you want to build a portfolio, then incorporation is potentially the way forward.
Yes, because I think the other benefit, and again, it depends on individual circumstances, but let's say, for example, that this is a man and wife or partnership owning this limited company, and then they're thinking about children or grandchildren. Well, if they want those children or grandchildren to share in the benefits of this portfolio, what you don't have to do is start worrying about conveying part of the ownership of the property to them, because a company is controlled by share capital. So it's about, you could gift a share under certain rules without paying any tax, but you could transfer ownership of the company or part of the company to a child, to a relative. Yes, you've got to watch the value and whether there's any capital gains tax and all the rest of it, but you don't have to start messing around with conveyancing and stamp duty and all the other issues. So you can add more owners to the portfolio via a limited company in a much easier fashion than you could if they were personally owned.
Okay. And then just on that point then, when you're talking about children and property, IHT, so inheritance tax, what's the benefits there for being in a company or owning it personally?
Well, in essence, IHT, which is also applicable, I hasten to add again, for non-residents of the United Kingdom.
It's the same rate?
Yes, it's the same rate. But in essence, there's two different approaches. So if you personally own property, investment property or any other property for that matter, then on your death, it forms part of your estate. So you would add the value of the investment property, less any mortgage that's still on that property, obviously, because that's a liability up to your estate. And your IHT liabilities would be assessed on the net value of your assets and liabilities. When it comes to owning them through a limited company, you're not valuing the properties, you're valuing the shares in the properties. So, in the company, I beg your pardon. So the executors of your estate will be saying how much are the shares in this limited company worth rather than what the underlying assets in that company are.
Okay. But surely there's a correlation though between the value of the company and the assets that are held in it.
Yes, of course. But by the time the investor gets to, sadly, the point of his demise, his or her demise, there might be a whole raft of other things in there. He might have decided to change activities. He might have a holiday let in there in Spain. He might have all sorts of things in there. The point is that it's the shares that are valued, not what's inside the company per se.
Okay. So if you've got some properties that you've made losses on, and then some properties you've made gains on, you can neutralise that?
Absolutely.
Okay. Right. Would you tell us a bit about stamp duty currently?
Stamp duty. I'm going to have to refer to my because it's very much a moving target at the moment, and has been during this worldwide pandemic in particular. There's been certain stimulus and everything else to the property market,
and that's why I asked, because we are asked the question, what will the stamp duty be? And although we can give advice, or at least not advice, but we can guide them to sort of, what it is right now, it's quite a challenge to sort of almost, to give them, to give clients a definitive answer to the question, because, it's very changeable.
Yes. Well, obviously it's a scale rate and it depends on the value of the property. But if you're typically thinking up to around the $500,000 mark at the moment, you'll pay 3% stamp duty.
Okay.
On properties up to $500,000, that's only up until June.
Okay.
From July, you'll pay 3% for properties only up to £250,000. So they're reducing the sales value. And then from October, you'll pay 3% for properties up to $125,000. For properties up to $250,000, you'll pay 5%.
So that's the taxation at the point of acquisition, and I know you've touched on the kind of the different strategies from a structure perspective, how one should buy sort of the property, whether it be in their individual name or as a company. So tell us a bit about what the offsets are. So what should our watchers and listeners be accounting for when they own a property? Because I know it's very important both when you own the property as well as when you come to sell it. So can you tell us a bit about the type of information we should be logging in expenses terms? So I know your ground rent service charge, but is there anything else we can add to that?
Yeah, there's two types of expenditure that the investor needs to keep an eye on. First of all, what I would describe as capital costs. So that is everything from the point of purchase, legal fees, stamp duty, and any costs associated with the purchase, agency costs or anything like that. And then any major capital costs on the property itself, so new bathroom, new kitchen, new roof, those sort of things are all costs that need to be maintained against your subsequent capital gain if you ever decide to sell it. Okay. And then the other costs are the running costs, so the costs you incur to generate the rental income from that property. So management fees, tenancy fees, legal fees to renew tenancy agreements, agency to manage the property, any repair costs, again, some people rent these things furnished, some people rent them unfurnished, so remedial repairs to furniture, which tend to get damaged by tenants along the way.
So just on that point, it's tax deductible?
Those are all tax deductible against the gross rent that you receive.
So it's important then that we keep a good log of those, because everything's tax deductible ultimately.
Absolutely. Preferably, I would always advise, whether you own these properties personally or corporately, I would always advise a client to maintain a separate bank account where the income and the associated expenditure on those properties go out of that single account.
And just on the furniture point, what's the difference there on the nuances of kind of furnished, unfurnished? What's the write down there? You get a is your furnishing fully tax deductible?
Not the initial cost would be of a capital nature, but the remedial costs would be allowable against the rental income.
So just explain that then.
So if one of your tenants breaks a leg on a dining room table and you get it repaired or replaced, then that's allowable against the income. But as I say, the major capital costs are part of the capital value of the property. So if it moves, it's generally speaking allowed against the rent.
Okay.
If it's fixed, it's generally not. So a bathroom suite, you can't sort of take it away with you.
Yeah. So replace the bathroom suite, and then you'll get that as a tax write-off at the end.
At the point of sale.
Point of sale.
Property.
And then anything like a furniture pack or an expense that is paid to an agent. Or
there are some greys in the middle of that, but I think you probably haven't got long enough to listen to all the arguments. Okay.
Well, that gives us a good overview.
Yeah.
A specific question then that came in for today. Client of ours currently buying a property, and he's based in Hong Kong. So the question was, should he set up a company, and is there any particular benefits? Because I know it's different for non-UK residents. So is that, you'll be able to give us a bit of a...
Yeah. Well, I think the first thing I would say to your client is he needs to take some advice in Hong Kong about his tax position there.
Just for his personal tax that he pays in that jurisdiction.
Because in different jurisdictions, they have different taxation positions on worldwide income. So if he's benefiting from income elsewhere in the world, he needs to check what the position is in Hong Kong.
Okay.
But I would generally say, and this applies across most jurisdictions, that if you own the property personally, then after you've had all your deductions and repairs and all the other costs, then that net income is your personal income and needs to be taxed somewhere, whether that be in the UK or Hong Kong, whatever.
Okay.
However, if you own the property corporately, then the net income of that company is not your income, it's the company's income on which you've paid 19% UK corporation tax.
Okay.
So if you don't distribute any of the profits to the owners of the company, i.e. your investor, then he has nothing to return because he hasn't received any worldwide income on that property. So again, depending on his strategy, if he wants to shelter that income, you may have investors that live in jurisdictions where any worldwide income is taxed at 50, 60, 65%. Well, the better way to do it is to keep that money inside a UK company, and you only pay 19%.
Okay. So on the basis he sets up the UK company, owns the property through that, takes the rental income, and then doesn't ultimately draw down. He's paid his corporation tax. He doesn't have to submit any information then to his local. Well, again,
I'll generalise. It depends on the jurisdiction, but ordinarily, if he is not distributing any of the profits out of that limited company, then he has received no personal income outside his jurisdiction.
Okay. Right, and then generally on non-resident landlords, what's the situation for them? Just in simple terms. So aside from however they own the company, however they own the property. Sorry. they'd need to fill out there's a form that needs to be filled out for a...
Yes, it only applies for personal ownership, because obviously if you've formed a UK company, it's already going to be paying corporation tax. The non-residents revenues approach to it is they want to make sure that if they're due any tax on property, that they get it. So they want non-resident landlords to register with the UK tax authorities. So what they've come up with is a system that if you haven't declared who you are and registered yourself with the UK tax authorities, then your agent has to deduct 20% of the rental income at source and remit that to the tax authorities.
So your letting agent?
Your letting agent, correct. If you don't have a letting agent, which I wouldn't advise you not to have, but if you don't, then actually the tenant themselves are obliged to deduct the tax and remit it to HMRC. I can imagine how many tenants would be doing that. But
I doubt many tenants would know, would they?
Probably not. But good advice is get yourself a good quality letting agent to deal with these things. So if you make advanced application, which can be done very often by your letting agent or by somebody like myself, you get yourself registered with the HMRC authorities, then you can have your rent paid to you gross.
And generally, as we kind of get into this whole, the taxation, both for acquisition as well as sort of throughout the process, it's a difficult subject to talk about because it seems quite arduous. So, and obviously that brings us on to say employing someone like yourself, sort of, a professional that can manage it for them. What are the type of costs involved? So, for someone like yourself to manage a client's company that owns properties.
Okay. Well, again, two types. So we've got the personal ownership situation, and they will be obliged to file a UK personal tax return every year.
Okay.
And we operate a sort of a scale rate. So depending on how many properties you've got will dictate the cost of the return. But they start from about £300 a year for a personal tax return and will go upward if you've got several properties personally owned.
Okay. So they've got an accountant in the UK. All they would need to do would just be to advise that accountant that I've also now got a property, and can you add X amount of rental, gross income, net income?
Yeah. We'd need to see the records and everything else.
Yeah. So my rent roll was X. These are my expenses, as we spoke about earlier.
Yeah.
And then the accountant then just submits that alongside your other income in the UK.
That's right.
And then for someone like yourself, so if it was an overseas landlord and they didn't have an accountant in the UK and they employed someone like yourself, your cost might be around £300.
£300 for a personal return. Yeah.
Okay.
Yeah. There are obviously some initial setup costs, but other than that, it's annually about that figure. If they do it via a limited company, then the costs rise, I'm afraid, because you need to file a set of accounts compliant with all the Companies Act legislation. So you have to file those with both the Inland Revenue, with the Registrar of Companies. Again, we have a scale rate. So if you've just got 1 to 2 properties in, the compliance costs of preparing and filing those returns are cheaper than if you had 6, 7, 8, 9, 10 properties. It starts at about £700 for the preparation of the accounts.
Okay. So you'd expect to spend about £1,000 a year, maybe?
Yeah. Around that mark, which is why I said earlier, you need to have a few properties. Having a single property inside a limited company, it doesn't justify the compliance costs that the investor is going to incur.
Okay. Well, thanks for your time today.
You're very welcome. Thank you.